All right, here we go. We're live. Fixing a few things, getting ready to go. It's 4:30. Thank you so much for joining me. I'm Mitch Goldberg. You're watching my live stream, Be the Boss of Your Money. It's about personal finance, investing. Hopefully, I am imparting to you wisdom that I've learned in a 30-year plus career and continuing. I've seen so many clients overcome challenges. I've seen so many people become successful through saving and investing for the long term. And I've seen so many people, even more people, um, view their past with a good amount of regret because they waited too long to invest. They didn't have the financial habits that were healthy to begin with. And, so I want to correct that. And I want to making sure my mic is on, I want to make sure everybody can do the best they can. We talk a lot about investing here, but investing is important. Part of the reason I talk about investing so much is because when we go through rocky times, there's politics, there's the economy, there's so much going on that I think people have a tendency to make mistakes, emotional mistakes. They're not sticking to their plan. They're not. They're buying and selling in their portfolios to try to manipulate the returns, to trying to force better investing returns as opposed to just investing based on a process like dollar cost averaging the same amount every month, the same dollar amount every month, and just letting the process work, let the results show for themselves down the road. When you're investing for the future, when you're planning for the future, it's hard to have confidence sometimes. Like, what if I'm not doing the right thing today to help me tomorrow? What should I be doing today to help me for tomorrow? So I'll have more financial security down the road. So I'll be able to live the lifestyle that I desire down the road. What if it doesn't work? What should I do? What should I do differently? What should I stop doing? These are all the questions that circulate through people's minds. And it's normal to do that. I mean, hopefully you are doing that. Like you'd have to have your head in the sand if you're not doing these things. So I want to give you the clarity because most of you know that you have to do something, and most of you know more or less what you have to do, but it's still chaos in your head about how to get there. So I coach you in this show as well about personal finance. Now, while you're watching this, whether if you're watching it now in the live or if you're watching this in the replay, hit me up with any questions you have in the comments. I love hearing from you. It's the best part about what I do. I love that. And if you have a question, it means somebody else has a question about it. And you're helping everybody out. You're doing the world a good thing. Plus, you're helping yourself at the same time. And while you're watching, give us a like, the thumbs up, the heart, the applause, whatever the reaction is, depending on which social media platform you're watching on. I stream to a whole bunch of them: Facebook, LinkedIn, Twitter, and YouTube. And it's always good to hear from you. And I get to see who's watching. When you give it a thumbs up or something, I actually get to see. I get to see your name, and I think that's really cool. So it's nice to know who's watching. I do get people coming up to me all the time and saying, "I watch a show, I watch it, I see it, I saw it," and I want you to know I really appreciate that, and it means a lot to me. It means more to me than you'll ever know. It's really a special thing. So we're going to talk about the market. We're going to talk about the haves versus the have-nots. We're going to talk about who's doing well now and who's not, and it's reflected in the stock market. So let's roll it over to the what do you call it? To the intro, and then we're going to get into these things. Okay, here we go. Okay, thank you for joining me. We're just getting started. I'm Mitch Goldberg. I'm a financial advisor with the firm Client First Strategy. It's a wealth management firm. And you're watching this show about personal finance because you're here to learn. Do you know how to budget? It's a simple question. Do you know how to make a budget? Do you know how to budget? Most people don't. You could say, well, okay, here's what I'm going to spend for the week. And I believe based on what I'm going to do, what I'm going to eat, where I'm going to go, when I'm going to fill up my gas tank, pay for heating oil, whatever, gas for the house, whatever it is, what's your budget? And most people don't really know. Where they say, "Hey, I'll have to spend about 10,000 a month to live." Some people less, some people more. And is it enough? No, not really. I don't feel like I'm getting ahead in my life. So what are the leaks? So then people try to itemize every little thing and see what they could cut. And it's not hard. I mean, it's not hard to cut things, but people get into inertia. Like you're stuck with, Netflix, Hulu. I'm not saying that saving $10 or $15 a month is going to make it, but I'm saying is if there's an overall pattern of lack of discipline, then it's going to be hard to start to cut things out. Some people make a big deal about buying, a $3 cup of coffee at Starbucks, $3 cup of coffee. Well, if you're buying coffee at Starbucks, then you don't know how to budget. I beg to differ. If there's room in your budget for Starbucks coffee, whatever, you know, little luxury that you enjoy, then by all means do it. The idea of a budget is not supposed to be something that makes you so miserable that you can't stick with it because now you're playing a really bad psychological game on yourself. You're playing a losing hand when you have to rely on really really bad psychology in your head. So what I want you to think about in terms of making a budget is priorities. What are the things that you want? What are the things that make you happy? I'm not saying that you can't go by I'm not saying you can't go by needs. I got someone calling me over. I'm not saying you can't, you shouldn't say your needs. Like, oh, paying for my heating oil for my house doesn't make me happy. I'm not saying you should skip that. I'm saying after your necessities, what are the things that make you happy? Like one of the things that makes me happy is, I like to splurge a little on certain things. You know, gym equipment I've splurged on, right? The equipment like the cameras on my live stream, so I could switch cameras and do this and do that and do this. Well, we all have our things we like to splurge on, but I make room in my budget for a splurge for something that I enjoy. And you have to do that. It's just that you're probably spending money on a lot of things that bring you joy, but only a little bit of joy. I want you to prioritize the things that bring you a lot of joy. Like if you're doing something because you're used to it, because I have a gym membership. I never go to the gym, but I enjoy it when I go to it, but I don't get that much joy out of it. Well, you get joy out of it, but if it's not a lot of joy out of it, then cut that out. You can always actually go back to the gym. Believe me, there are gyms all over the country that would love to have your business, but then cut that out. If it's like, well, it's nice to know that I have Netflix if I want to watch it, but I haven't had time to watch anything in like 3 months. But I just like to have the subscription in case I want to. That's the kind of thing you should get out. Believe me, you can always go back to Netflix. They will be happy to take your subscription back. They love that. But I want you to find the things that you really enjoy after you pay, after you pay for your needs, and that's what I really want you to prioritize. I want you to splurge, but something that really brings you a lot of value, not on things that are just things that you're used to, things that you used to enjoy, but you don't really enjoy anymore. You'd be surprised if you look at what you spend money on, how many things you spend money on that it's like you built joys on top of joys. So you're spending money on something and then you're spending a little bit more money on something else, a little bit more money on something else, but you're clinging to the old things that you're spending money on because you used to enjoy them. So you think you still do, but they've lost their utility for you in your life. Those are the things that you should cut out. If you're a Netflix watcher and you watch Stranger Things and other shows all the time, don't cut out Netflix. That's not what budgeting is. But if you have Hulu also and you never use it, well then cut that out, right? You have a subscription to a club you're in and you never use it anymore. obviously you should get rid of it. But if you think, yeah, but I might want to go back, I did this with the gym. I'm thinking, I haven't been to the gym like more than once in the last 5 or 6 months. I have really good workout equipment at home, but I like going to the gym. It's a little different, a little variety. I like to see the people there. But I'm like, you know what? I don't really get that much joy from it anymore. I cut that out. And once I cut it out, I don't miss it. Believe me, the gym membership that I dropped, the gym, they would love to have me back. You can always go back to it. But that's what I mean. So a budget starts with needs and then priorities. The things that you really, yes, I know needs are priorities, but after you take care of the needs, what are the things that you really prioritize that bring you happiness? Anything else that doesn't bring you a lot of happiness, like you could chart everything down, like brings me a little bit of happiness, old happiness, but not happy anymore, major happiness, and massive happiness. There's 4 categories. And anything that's not in like the top category, get rid of. You'd be amazed once you cut it out, you'll forget you even were paying for it. All right. So that's my story on budgeting. Now I want to move to like I said, we talk about personal finance here all the time. I want to hear from anyone out there who's looking to purchase a home now, who's been looking for a long time, and now mortgage rates are up a lot this year, but the home prices are still about where they were. It's like, well, if I could afford a house for $800,000 and our mortgage rates are up, maybe you can only afford a house for 600,000 or 700,000 or 500,000. I want to hear from you if that's the case, because I don't think sellers are really getting it into their heads yet. But if sales and housing gets weak enough, sellers will start to lower their prices. It just takes a long time. All right, let's talk about a couple of things. I'm going to pop one of my screens up. All right. So after the close today, Texas Instruments came out with earnings, and it's up almost $4 after being down over $2 today. Nasdaq was down a lot today, so tech stocks were down. Okay. Walmart, but Texas Instruments was down $2 during the regular session. Walmart, it says down 4 cents, but keep in mind, Walmart was down $10 today. There's a message there. Target, which was as high as $268 a share, its year high is now $151 and was down over $5 today. And McDonald's was up $6 today. So there's a message here. And the message is this. I'm sorry for making you dizzy switching around. Okay. First of all, Alphabet's up after market trading, after being up a little bit. It was down a little bit today in regular trading, and then after market, it's just made up for its loss with the earnings report that missed expectations, but they had good things to say. If you could see Alphabet, which is Google, I don't know if you know that Google changed the name to Alphabet, but if you could see Google Alphabet hold up okay over the next couple of days, in spite of not a particularly stellar report, because the stock is already down a lot year to date. It's down to something like 25-30% year to date. If if you could see Alphabet hold up, I think that gives me confidence about the broader tech market in general. Okay. Texas Instruments had a decent day, and Texas Instruments is all about supply chain, and they came out with decent numbers, and a lot of CEOs and CFOs are talking about that they see supply chains clearing up. Automakers are really suffering from supply chain issues, in particular semiconductor chips. So Texas Instruments is in a lot of cars, or chips are in a lot of cars. So if they're doing better, you could start to think that supply chain issues are clearing up, and we'll start to see auto manufacturing go up. Okay. Auto manufacturing in the United States is something like, I don't know, 13 million units a year, when the country needs like 16 or 17 million new units a year. So we have a long way to go to catch up to demand for the auto manufacturers to start overproducing cars. Okay. Walmart was down $10 as we spoke, and Target was down $6. But both stocks got hit really hard today. Why is that? Because um, inflation. Walmart and Target. Target stock was down 25% like a month and a half ago in one day, which is a huge number for Target. There's a bifurcation in the economy. People who are in the lower end of the income spectrum in this country are suffering incredibly from inflation. They only have a little bit of money to spend each month. That little bit of money doesn't go up much to keep up with inflation, but everything they buy has gone up a lot. So they're buying fewer and fewer things and they're trading down. So Walmart, the problem is Walmart consumers, which is considered, no offense to anyone, it's considered a lower income, a business that serves lower income people. People are spending more on the cheapest food they can get and less on discretionary items at Walmart. So Walmart's got a lot of inventory to blow out of, so they're going to have to start discounting things. And they're doing it like right before back to school and right before Christmas. So it's not really a great thing for Walmart. And that's why Texas Instrument, Target is down. So it's just such a haves versus have-nots kind of market. And I don't see how that's going to change. Now, one thing we've been talking about is there's been a push for performance because the stock market's been bouncing off its lows, with the exception of today. We'll see if the recent rally in the markets can continue. But when you have mega cap stocks like Walmart and Target go down, and mega cap tech stocks, which are super mega caps, let's call it that, Microsoft, Amazon, if they're not doing well, it's really hard for the stock market to catch a bid and go up a lot. Stock market's not going to be able to just make it on, a small company. You need the super large cap stocks to start moving up again, and it's really tough to envision that. Having said that, I'm still a little bit more bullish on stocks going forward, and I don't like to call it both ways. I just want to call it. All right, I'm bullish on stocks over the long term, which is obvious. We're all bullish over the long term. But if you're a long-term investor and you're buying for 10 years or more, I have to say 99.9% of the stuff that you hear and see in financial news is meaningless. How often has CNBC been talking about the battle with Twitter's board and Elon Musk, or Elon Musk is possibly screwing around with another CEO's wife, whatever? It's gossip. It's hearsay. This stuff means nothing to my client's financial future. You know what means a lot to my client's financial future? Having an updated estate plan. Knowing the most optimal time to claim Social Security in their life is. Investing every month. Buying real estate as an investment property. These are the things that people do to accumulate wealth. They don't give a crap about Twitter's board suing Elon Musk to buy Twitter. It's meaningless. And these are the kind of things that we see all the time in financial news media, but these are not the things that are going to make or break your retirement. I just want to keep you focused on the right thing. I think that's pretty much all I wanted to cover today. Let's go over the overall. Oh, you know what? Let's just take a quick look here. Okay. So let's look at the major averages. Dow down 228, not a big deal. NASDAQ down almost 2%. That's a big deal. S&P down over 1%. Kind of a big deal. Gold can't catch a bid. If you're really worried about inflation, gold should have been a lot higher. And gold has been telling you this whole time that we've peaked in inflation. And again, I've been saying that for a while. Inflation has peaked. It's coming down. Base metals, oil, lumber, food prices, everything's been coming down this year. And you'll start to see that in the prices that you pay, also known as the Consumer Price Index. Oil down to 95, the 10-year yield down to 2.8%. The VIX is up a little bit, but that makes sense because it's a down market. The VIX usually goes up. That's the VIX. The VIX usually goes up when the market goes down. And the VIX is the volatility index. It basically tells you that professional money managers are willing to pay more or less to hedge their portfolios. So the more they're willing to pay for to hedge their portfolios, especially in the down market, the more the VIX goes up. Okay. Bonds. Continuing to see the 2-year yield that see it's got a 3 handle. You see that 3? And the 10-year has the 2. All right. So as long as the 2-year is higher than the 10-year, it's screaming recession. GDP numbers are coming out on Thursday. I think we get a mildly negative print. I think we have a recession on our hands. I think we've been in a recession this quarter. We'll see. I could be wrong. But for a lot of you, it's going to feel like a recession anyway. And I see a lot of slowdowns in the economy, a lot of deterioration. And people are starting to think that because of that, the Federal Reserve is getting through its period of tightening, of raising rates, of tamping down demand to slow down inflation. And that would mean the Fed, if it's at the end of its rope, that's good for stocks. And then the Fed could start cutting rates and the stock market could start to rally again. And this is just the ups and downs that I've observed for the last 30 plus years of being a financial advisor. It's not changing anytime soon. And I think it pays to not make decisions like I'm either bullish or I'm bearish. You could be somewhere in between. Okay, now I'm done. I will see you guys tomorrow. Thank you very much for joining me. And if you do think of anything that you want to ask me, hit me up in the comments. I'll be sure to see that. Thank you very much.